Good afternoon, everybody. Can you hear?
Good afternoon, sir.
Okay, you're welcome. And I will screen. And okay, excuse me. And I think we can start learning. And in the last class, we have this one example. Excuse me. Regarding the case conversation cycle of working capital management policy, and we have it. So how we treat under the conservative policy and aggressive policy. And now we move to the next section of the subchapter. Right. Operating cycle, sometimes called as case cycle, right? And operating cycle is the time duration required to convert sales after the conversion of resources into inventories into cash. Simply, operating cycle means uh, simply it means operating cycle means once you start to purchase inventories, say for example, you start to buy inventory on 1st of January 2020, and you keep the inventory for 1 month, and you start production on 1st of February 2020, and it takes another 1 month to convert this raw material into finished goods. During the period of work in progress, 1st of January to 28th of February. So during this period, you convert inventory as a finished good. So at this time you include the savings from the laborer, and also it include overhead cost. And again, you keep the raw material finished good for 1 month in your store, and after 1 month you make sales, and again you wait for another 1 month to receive the cash from your customers. So it's a cycle, no? So operating cycle is simply, it start from the time required to convert its raw material into cash. The total time required to convert the raw material into cash. In this time frame, we can find there are so many processes, so many events: purchase of inventory, keeping the inventory, inventory means raw material, and we convert raw material into finished good during this work in progress period, and we keep the finished stock, and we have to keep the finished stock, and we make sales, and we have to wait for a period of time until we receive the money. Once we received the money, we have to settle the money to our creditors if we purchase raw material on credit basis. So it's called operating cycle, right? That's what it says. Operating cycle is a time duration required to convert sales after the conversion of resources into inventories into cash. Inventory into cash. It's a one cycle. The operating cycle of manufacturing company involves three phases, three parts. And number one, acquisition of resources, just purchase resources, buying raw materials. So acquisition of resources such as raw material, labor, power, fuel, etc. And the second space, once they purchased, the second space they start to make production process. So manufacturing of product, it's not a one activity, it's a collection of so many activities. Therefore it called as a process. That's why you have studied process accounting. So manufacturing of products which include conversion of raw material into work in progress into finished goods. And finally, once you make finished product, it's ready for sale. And sale of product either on cash or credit. So credit sales create another working working capital, that is working capital investment, that is receivable, account receivable for collections, right? So in summary, there are two pieces: acquisition of resources, manufacture of product, and sale of products. And here, this illustration, where you can find the first line represent the events. There is a timeline. So the operating cycle starts from at this point, purchase of inventory. Purchase of inventory, it may be in cash or on credit. If you purchase on credit, and then another liability occurs, current liability occurs, that is called uh, payable or creditors. So purchase of inventory, and inventory, so you keep the inventory for a period of time and you convert the inventory raw material into finished good, and it's ready for sale. And you keep the inventory finished goods up to sales. Up to this point you make sales, and then you collect from your customer, you collect cash from your customer. So this is the event line, and you see the process here, the inventory, purchase of inventory, and up from the purchase of raw material, inventory raw material or raw material, to the point sell of product, sell of product. The period between sales and the purchase of raw material, it's called inventory conversion into product, inventory conversion to product. And the period between sale of sales and case collection is called receivable collection period, right? So at the time here, so here, total cycle, right? The total, the period, the event start from here, purchase of raw material up to collection of money from your customers. So the total length is called operating cycle. Total length is called, total length period of time is called operating cycle. And from the operating cycle, if you divide the payable period, creditors period, right? So when you purchase raw material from your supplier, they will give you some certain days to resettle the amount to them. Say for example, they are giving 2-month period of time to settle their credit on purchase of raw material. So we deduct that payable period from operating cycle, then the balance figure is called as cash conversion cycle, cash conversion cycle, right? So we have to be very clear about what is operating cycle and what is cash conversion cycle, right? And right. So gross operating cycle, sometime operating cycle is sometimes called as gross operating cycle. Gross operating cycle and operating cycle both are same concept. Net operating cycle sometimes called as cash cycle, right? Net operating cycle is equal to cash operating cycle. Here we look at on gross operating cycle. The firm's gross operating cycle can be determined as inventory conversion period. So we purchase raw material and we convert the raw material into finished goods, right? So conversion period, inventory conversion period, plus we have to add a debtors conversion period. So we make the inventory into finished goods, and the finished good is ready for sale, and we have to keep the inventory for a period of time, finished good holding period, right? And once we make sales, again we have to wait to collect the money from our customer. So the total of inventory conversion period, debtor conversion period is called gross operating cycle. The inventory operating cycle consists of three periods. First one, raw material holding period, finished good holding period, and the period between these two is called work in progress conversion period, right? Work in progress period. So the simply gross operating cycle mean equal inventory conversion period plus debtors conversion period. And here is the inventory conversion period. Inventory conversion period is the total time needed for the producing and selling the product. Inventory conversion period is the total time needed for producing and selling the product. So therefore, it, as I told you earlier, it takes two stages: in raw material holding period, work in progress, and finished good holding period. Right here, number one, so raw material holding period, a work in progress conversion period. We convert raw material into finished goods, and once we produce our product, it's become a finished good, and finished good holding period. We have to keep the final product for a period of time. So simply inventory conversion period equal raw material holding period, work in progress conversion period, and finished good conversion holding period, right? And so now we move to the equations. These are very important. So inventory conversion period equal average inventory. The top we have to put average divided by cost of sales. Then again we have divided by 365 days. 365 day inventory conversion period. So you may study financial statement analysis. There we have studied a lot of accounting ratios. So how do we calculate inventory turnover? Inventory turnover, how do we calculate? Anybody of you? How do we calculate turnover? Inventory turnover, please. How do we calculate inventory turnover? Anybody of you voluntarily answer, please? It is necessary. How to calculate? How do we calculate how many times inventory is turned? Inventory turnover period. Anybody of you? The inverse of the equation, regardless the number of days. Say uh, inventory turnover equal cost of sales divided by average inventory. How do we calculate average inventory? Closing balance plus opening balance divided by 2 is called average inventory. And cost of sales, as an accounting student, you know how to calculate cost of sales. And from inventory turnover we can find what we can find inventory conversion period, right? We right. And second, then the second part of the operating cycle, gross operating cycle, that is debtors or receivable conversion period. Debtors or receivable conversion period. Debtors conversion period is the average time taken to convert debtors into cash. It's the period between the sales and the collection of cash. So debtors collection period represent the average collection period. It is calculated as follows. Debtors conversion period equal debtors. Debtors, average debtors, sometime average debtors divided by uh, credit sales, not total sales, credit sales. Not it. This formula not include cash sales, right? It includes only credit sales, right? Into 360. Then the liability side, when we purchase our raw material on credit basis, we have to settle that, settle to our creditors. So how do we calculate creditors payable periods? Creditors or payable period, deferred period, deferral period is the average time taken by the firms in paying its suppliers. And finally, the creditors payable period, average credit divided by credit purchase, right, into 360. Now right, we move to case conversion cycle or net operating cycle. Case cycle or case conversion cycle, net operating cycle. These three terms are used interchangeably. And net operating cycle is the difference between the gross operating cycle, and the payable deferral period. We know the gross operating cycle equal inventory conversion period plus debtors conversion period. That is equal gross operating cycle. So net operating cycle equal gross operating cycle minus creditors deferral period. And net operating cycle is also referred to as cash conversion cycle. Right. Now we will work out this example to understand case conversion cycle. Right. Here you have collected the following information for the slow pay company. The name of the company is slow pay. Right. The items are given. Items inventory, opening balance given, and ending balance both are given. Inventory 5,000, 7,000. Account receivable also given 1,600, 2,400, and account payable 2,700, 4,800. Sales for the year just ended were 50,000, and cost of goods sold 30,000. And the question is, how long does it take slow pay to collect on receivable? How long does the merchandise stay around before it's sold? How long does slow pay take to pay its bill? So they are simply asking debtors collection period, inventory holding period, and debtors payable period. So we'll work out on this, right? We will work out. And we'll do this calculation on Excel sheet. I share my screen. And right. Can everybody see my Excel sheet?
Yes, sir.
Okay, good. Right. Now we need to calculate say gross operating cycle. Gross operating cycle equal inventory conversion period plus debtors collection period minus, sorry, right, and net operating cycle, or sometimes called cash cycle, equal gross operating cycle minus creditors payable period. First, we will work out how to calculate inventory conversion period. Inventory conversion period. So, what is the equation? What is the equation? We need, what are the informations? We need average. So here, opening balance, closing balance, right? Opening balance and closing balance of what? And first inventory and debtors and creditors. Right. Opening balance how much? Inventory?
5,000.
5,000. And closing balance?
7,000.
7,000. And debtors?
1,600.
1,600. And
2,400.
2,400. And creditors?
2,700.
2,700. And
4,800.
4,800. Thank you. And we need sales. How much sales for the period? 50,000, no?
50,000.
And cost of sales?
30,000.
30,000. Right. To calculate inventory conversion period, so what's the equation? Equal average inventory divided by
Cost of sales.
cost of sales, right, into 365, isn't it?
Yes.
Into 365, right? And debtors collection period equal average debtors over credit sales, or credit sales into 365. And creditors payable period equal average creditors over cost of sales into 365. Assume that there are 365 days in a year. When apply this equation, how much average inventory? How do you calculate average inventory? Opening balance plus closing balance divided by 2. Then, all right. Opening balance equal 5,000 plus closing balance equal 7,000. Then I get 2 average, right? Average is 6,000, right? Average 6,000. And cost of sale how much? 30,000, right? Cost of sale 30,000. Divided by 30,000 and into 365. How much? How many days?
73.
73 days. Inventory conversion period. Likewise, debtors collection period, we have to include what average. First, we have to calculate the average debtors. That is 1,600 plus 2,400 divided by 2, and we have to divide it by credit sales, that is equal 50,000 50,000 50,000 again. It should be multiplied by 365. 14.6 days. Is it correct? Is it correct? Can you do it manually?
Yes, sir.
Okay. Then creditors collection period. How do you calculate? Average creditors. So I will do it like this. First 2,700 also opening balance plus 4,800 average 2,700 plus 4,800 divided by 2, then we will get the average, and this value should be divided by cost of sales, that is 30,000, and this figure should be multiplied by 365 days, and 45.625. Then my question is, what is gross operating cycle? How much? How many days gross operating cycle? Inventory conversion cycle plus debtors collection period. How many days? Equal 73 plus 14.6. Right? Then net operating cycle equal gross operating cycle minus collection period. 41.97. Clear? Clear?
Sir.
Is it clear, right?
Sir.
Okay. Any doubts?
Yes, sir.
Do you have anything to ask?
When we calculate debtors conversion period,
Yeah, debtors conversion period. Yeah.
we have to consider the credit sales.
Yeah. Yes, credit sales.
Then we don't have to consider opening debtors, closing debtors.
No, no. So credit. So your question is, when we calculate the debtors conversion period, so the equation is average debtors. No, average in when if
Average,
they
sir.
if they make all the sales on cash basis, there is no debtors. No, so the debtors collection period is equal to 0. If you make every sales on case basis, so you couldn't find this balance. Now you are
Yes.
seeing you are unable to find this figure.
Yes, sir.
So then your the numerator in the formula here, average debtors equal to 0. Then your answer ultimately equal to 0. This value becomes 0.
No, sir. I'm asking.
Yeah.
This year sales is 50,000.
Yes.
Don't we have to add 1,600 and minus 2,400 to calculate this year credit sale?
No. It's a balance. Sometime. Did you study the case balance? Case budget? Have you studied earlier in other subjects? Case budget. When you're preparing case budget, you have learned So once they make sales, 50% of credit settle within this month, 25% of the credit sales will be settled in next month, and balance will be paid that month. So we can't say this is equal to sales, right? If you make sales here, 50,000, no, 50,000. In this example, we considered all the sales are on credit basis. So this year sales equal 50,000. This year sales, right? So within this 50,000, some people paid already. Some people settle their money at the beginning, in the middle, right? Likewise. Have you make sense?
Okay, sir.
So if you are not clear, you can ask.
Yes, I got it.
Okay. Then, so this sales equal to, so for example, the financial year start from 1st of January 2020 and end on 31st December 2020. So this 50,000 total sales from beginning to end. But here, so sometime you may give your customers to settle the payment 15 days or 1 month or 2 months. Here this 50,000 include the sales you held even on January, February, March, April, right? This closing balance may be the sales of last month, December or November, and this balance may be the sale of 2019 figure. So we no need to consider here. We just apply the formula, right? You have to understand what is the logic behind the calculation, right? Okay, clear? Clear?
Okay, sir.
Okay. Then, right. Now we move to the second question. Second slide. Yes. Right. Can you do this? Or I will explain it. This one also. Same thing. So I will do it. Some of you are not clear, right? Shall I do it or you can do?
You can do it, sir.
You can do, no? Okay, then we move to, so this also you can do yourself. Nothing new. The figures are changed, right? Figures are different and everything. So if there is no information regarding how much credit sales, how much cash sales, you don't worry about. You can assume that all sales are made on credit basis, right? And matter of fact, so what is the meaning of this one? So we have calculated, okay, you are very good at calculation. So what do you mean by this 41? What do you mean? What do you mean it? So what is the meaning? Right. Okay. Now we will come one by one. Right. So what is the meaning of this 74? 74 days. What's the meaning? What does it mean? Anybody of you? What does it mean? Inventory conversion period. What does it mean? Anybody of you? Just everybody can calculate the figure.
Total time for processing.
Processing what?
Total time for producing and selling the product.
Yes, it's a time period, right? It's the time period between purchase of inventory, right? Purchase of inventory and sale of finished goods, right? In these 73 days, we can divide it into 3 phases. First one, purchase of raw material, right? Purchase of raw material, say for example, it takes for 30 days, right? You purchase raw material and you keep the raw material in your store, warehouse, so it takes 30 days. And you start production, you want to make the raw material into finished goods, so you start up your machine and you have to put the raw material into the machine will work, the machine will convert the raw material into output, so it takes 13 days, right? And after getting a finished good, and we have to keep the finished good in our store means your a showroom, right? Your shop as a finished good inventory. Sorry, you have to keep this finished good for 15 days, and you allowed, yes, uh, you keep the raw material for 30 days, you convert the raw material into finished good, it takes on 13 days, and the finished good takes to make sales 30 days. Total how many days? 73. This 73 is called inventory conversion period, right? We convert raw material inventory, we convert raw material into sales, right? And what does it mean? What does it mean? This one, 14.6, 14.6 mean what? Debtors collection period, it mean what? What's the logic behind it? Once you make sales, you have to wait how many days to collect money from your customers?
14.6 days.
Yes, almost 2 weeks, right? Almost, you have to wait 2 weeks to collect your money from your customers. Then total, how many days you have to wait? How many days you have to wait to make it cash? Raw material into cash. How many days you have to wait? 87.6 days. 87.6 days you have to wait to collect, to convert your inventory into cash, right? So quite long, no, isn't it? 87 days, it almost 3 months, isn't it? Out of 12 months we have to wait to convert our inventory into cash. It takes almost 3 months, right? Then what do you mean by this 45.625 mean what? It's what?
Total time for
Yes,
paying.
yeah, good, very good. So we purchase inventory on credit basis, and we have to settle the money to our suppliers. We have purchased the raw material on credit basis, so they are given 45 days, 1.5 months almost, right? So we can shorten down the total conversion period into 41 days, right? It's mean we don't need to pay the money at the time of purchase of inventory, so they are giving up 45 days. My battery is out, not charge, right? So I will, do you have any free time today? Do you have any free time today? Tomorrow? Oh my goodness. It was off.